Ladies and gentlemen, boys and girls, and children of all ages, welcome to the Investor Show. As always, this is your gracious host here, the Prince of Investing, Prince Dykes, coming to you guys and girls live all the way from the beautiful state of Denver, Colorado. Uh, as people catch this live, we will talk about it. Okay, so we got to look at what the Dow Jones doing today. We're going to have a good conversation today. One second here. Give me 1 second as we're going to have some good conversations. So as always, y'all come in, tell me where you guys and girls are from. We're going to have a guest in today. That's going to have a guest in today. He's going to be coming in a little bit later on. But until that, we're going to talk about some market news. Give me 1 second here. I want to get updated on what the Dow Jones is at. Okay, it's up 1,500 points. 1,500 points. All right. Let's get to some of y'all comments in here. Max B said it must be a good day today. Why do you say it must be a good day today, Max B? I know Max B is coming in all the way from Louisiana. We're going to have a special guest come in today. His name is Lars Krojier. I'm going to read off his little bio a little bit. Well, it's a huge bio to kind of talk about it. He's this is his book here, Investing Demystified. He had a couple books. Hedge fund manager, billion-dollar hedge fund manager, Harvard. He graduated from Harvard with his bachelor's in MBA, Harvard Business School, cum laude. Managed, of course, a big hedge fund for a while. And so he's going to come on here. He's in the UK, United Kingdom. So he hit me up earlier today and told me he'll be needed a little bit more time or whatnot. So I'm going to talk about some things before we get into it with him. So Max B said, "Why today is a good day." Let me get into you guys and girls. Kevin Prince, the market is skyrocketing. Did we miss the bottom? I don't think so. No, I don't think so. It's something I told you guys and girls every day. The market doesn't go down every single day. Just be patient. Just be patient. Just like when the market was going up, did it go up every single day? No, it had some days where it dropped down bad, then it shot back up. Look at this. Look at December of 2000. Look at Christmas of 2018. Look how the market just tanked out like 10 or 15% in one day or 2 days or whatnot. And then it skyrocketed. So same thing when you're going down. You're going to see bumps. So this is the time if you are XPXX person, Sierra Papa X-Ray Sierra, this is the day you get them. All right. Raw. what type of name is that? He says, "Is this a turning point?" I don't think it is. I don't think we've hit the turning point yet. I think that we got the stimulus package coming. I think people are getting excited, and I don't think we hit the bottom yet. Maybe I'm wrong, but it's just just be patient. I just want to see how everything pans out. Just because we had one good day, you can't say, "Hey, look, we're turning around now." It's just like something that I remember the boxer Floyd Mayweather said. He was like, a person wins one round against me, then everybody automatically asks me, "Oh, you lost that fight." He's like, somebody just finally won one or two rounds, and it looked like they won the fight. But we have Detroit in the house, Staten Island, Silver Alliance from Staten Island, Picasso, Irvine, California. Glad to see you back in today. We have Columbus, Ohio in the house. What's up with TLT? We'll get to that in a second. BA, did we miss the bottom? Boeing. I won't say that was the bottom, but I mean, everything is up today. Everybody, the market is up 1,500 points. Everything is up today. I won't say it's a bottom. Just don't let your emotions get tied into it. Use common sense. We're in a bear market. In a bear market, you're going to have days that are going up and then going bottom. Maybe I'm wrong. I want to acknowledge. I mean, I will acknowledge when if I think I missed the bottom, right? So don't get too what you call it. We got Miss Amber coming in from Philly. Miss Amber, now you can see how SPXL has probably shot down over 20% today. Oh, XPXL has gone up about 20%, but XPXS, you're going to see it shoot down about 20% or more today. So now it's a day when you see the market go up, make this big skyrocket up. Watch what happens later on this week. When we see these big jumps, 15, 1600 points today, then watch tomorrow come, because we're about to close a possible stimulus package, right? And and let's go over that stimulus package. So the stimulus package, which they're looking at doing, is giving every family, every married family up to $2,400 in taxes, not taxes, but same thing, $2,400 in stimulus checks, right? And they want to give $500 to every child, and they want to give $350 billion to small businesses, and they also are looking to aid the airline industry. So what is this telling me is that now the airline industry, they get bailed out, just like the automotive industry, just like the financial industry did in '08. All those companies took off. Who remembers when Bank of America was in the single digits? Bank of America was like $5, and in the bull market it shot all the way up to $300, right? Look at Ford was $1, almost a penny stock if I'm not mistaken, and it shot all the way up to like $15. So the airline industry will do the same thing. We just went over that yesterday. I'm going to upload that or whatnot. So nobody knows the true bottom, but we're going to try to see. Al's coming in from Chicago. Nice to see you back in here, Al. We got Miss Merlene Layson from Jacksonville, Florida. Okay, Jacksonville. Abraham, he's back in here on his bicycle out there in Houston, Texas. He said no one knows the true bottom. That's true. That's true. No one knows the absolute bottom. But don't be, what I will say is, when the market is going down, don't look at it, right? Don't get too crazy and being too concerned of trying to pick the exact bottom. It's like trying to pick the top. If I could pick tops and bottoms like that, man, I'd be a trillionaire, right? So, but I can know, and if I'm wrong and the market just takes off from here, you best believe I would say, hey, you know what? That was the bottom, guys. Let's jump into it. But when you know what the bottom is this technical data. When you see the market go down, it will hit a level, and then it will go back up. It was like a bouncing ball. It'll be like, whoop, boom, boom. And when you see it keep bouncing at a particular point, that's when you know you probably hit bottom. But sometimes it may bounce, go back up, then shoot straight through what you thought was the bottom. So like we was at 18,000. What's 18,000 the bottom? We hit 18,000. Now we're jumping back up. Guess what? We're going to come back down to 18,000 again. It's going to test that bottom again. And if the market shoots through 18,000, then we're going to keep going down. But sometimes it may just 18,000 may have been the bottom, or may be the bottom, but only time will tell. And guess what? If we miss the bottom, that don't mean we're going to miss the bull. I don't mind. Let's say the Dow is at like 20,000 right now. Let's say if it gets to 23,000, I'm like, oh, we're in a bull market. We're in a bull market again. I will jump right back on that bull like nothing's happened. All right, we got Wayne coming in from Chesterfield, Virginia. If and when companies file for bankruptcy, then will they close to? If and when companies file for bankruptcy, yes. Companies started like in 2008. That's when we started to see companies file for bankruptcy. So he's saying, one second, let me lower my chair here. My son always come in here and mess with my chair all the time. Sorry about that, guys. I was wondering why I kept pulling on my microphone. So, okay. All right. Miss Amber Mole says, I have eyes on both XPXS and XPXL. I have one SH of both. Oh, one share. I'm thinking she's saying one share of both in my Roth IRA currently. Yes, the XPXL will win. I mean, it's just a matter of time. The market's going to go back up eventually. When people say, oh, this may be the end of the world, I don't think that's true, because the reason why I don't think that's true, because eventually people got to go back to work. And in order for people to go back to work, companies got to open back up. And if companies open back up and people are going to work, that means companies are probably going to turn a profit. And if they turn a profit, there we go. We're back in the game. P Mac, what's going on? There we go. Hey, what's going on, Brian? Appreciate you for coming in live. A double bottom reverse pattern. Yes, what they're talking about, a double bottom reverse pattern, is that when we see the bottom, what happens is the market will go down to the bottom. It will hit it. So boom, it'll hit it. then it'll come back up like a bouncing ball. It'll bounce off of it. It'll come back up with possibly we could be seeing now. Then it comes back again, right? When it hit it again, if it can't push through that point and it goes back up, that could be the signal of a reverse of the market turning into hitting the bottom. Same thing at the top. When the market goes to, they call it a double head pattern, a head and shoulders pattern. So you'll see the market go up. It'll try to break through a point. It can't. It'll come back down. It'll try again, break through it a little bit, come back down, and then it hit it again. And if it can't do it, that's a signal of a bear market to come, right? So it's the same thing on the reverse side. So this is what I'm talking about, technical data here. So fundamentals tell you what to buy. Like we have fundamentally gone over and said Microsoft, Boeing, Google, Amazon, all of those are great companies to buy. But now your technical data is telling you when to buy. Everybody want to know when it's the bottom, right? I think that so with the stimulus package, what they're doing is they're giving out $350 billion to small businesses so that they don't lay off people. Because if this money doesn't get to small businesses, they're going to have to lay off people. You know, you can't just be paying people to sit at home. So if those people get laid off, those people are probably going to file for unemployment. If those people file for unemployment, that means unemployment numbers go up. Unemployment numbers go up, then people are going to start to, the market's going to start a downward trend. So the stimulus package, this $350 billion, is to say, hey, companies, small businesses, don't lay those people off because I'm trying to stop unemployment from going up. All right. So yeah, so that was the thing that we were talking about today. So another thing I wanted to bring about is I want everybody to look at their particular industries. What I mean by looking at your industries, I'm taking a look at them now. We're going to look at the 11 industries, and we talked about what are the 11 industries. And the reason I'm going to tell you why I'm bringing this up too. So you have a couple industries where one, you have consumer staples, you have energy, technology, financial, utilities, consumer discretionary, industrial, healthcare, real estate, materials, and transportation. So the reason why in this bull market, we see this jump in the market, the number one industry right now, take a wild guess, what sector is having the biggest return right now? Out of the ones I just named, what sector is having the biggest return? Right? 1 second, we have our 1 second, guys. I'm gonna go off. I'm gonna check with my guest, Mr. Lars Krojier here. So he's here. So let me pause it for a second. Let me go check with him, and I'll be right back with you guys and girls. All right. Lars, can you hear me?
I can hear you fine. Can you hear me?
I don't have your microphone.
Yeah.
Is your microphone good to go now?
Can you hear me now?
Yeah, I can't hear you right now. So 1 second, guys. We're working with Mr. Lars Krojier. We're trying to get his microphone in. I will read over his bio here for a second, and we're going to go over his some of his expertise. You know, he was around in 2008, economist. I don't know why. Let's see.
This is all very funny.
Hear and see our guest. I know you guys and girls can see me, but we're trying to see if we can hear and see our guest here. Once. Here, let me try one thing. Oh, y'all see y'all can. Oh, so I can't hear him. That's the problem. Okay. 1 second. Let me make sure. Y'all. So Lars, can you hear me, Lars?
Yes.
Oh, there we go. Okay, got it. Okay. All right. I'm doing pretty good, Lars. We have you on here live, and I'm gonna go over some of the people that are here as well. So we have a little live audience here. We have Detroit is here, Staten Island, New York, Irvine, California, Ohio, Columbus, Philadelphia, Chicago, Jacksonville, Florida, H-Town, Houston, Texas, Chesterfield, Virginia. So we have a live audience in here as well. So guys and girls, they were telling me they could hear you. I guess I couldn't hear you there. Okay. They were saying they could hear the guests. Okay, got it. So if you guys and girls have live questions for Mr. Lars Krojier, we'll go over them as well. Oh, and we also, some more people. We have Delaware from James Bond here.
You don't have many foreigners.
Yeah, I know, right? We don't have, but we have you here. Lars is calling in everybody from the UK right now. So,
that's right.
And then we got Chesterfield, Virginia. Oh, Chesterfield is here as well. B-Mac. All right. So let me give you guys an introduction to Mr. Lars Krojier. I know I spoke about him earlier on our live stream. I'm going to read a little bit of his bio. He has a very long and extensive bio, you know. And I'm holding his latest book here, Investing Demystified, so everybody can see it, right? And we're going to talk about his time in the financial industry, his expertise, what he's seen in the industry, all those are the good things. So first of all, Mr. Lars is a Harvard graduate, business school, cum laude. He's been seen on plenty of financial shows. I'm just going to sum it up pretty quick. You know, he's a hedge fund manager, high end of finance. He is, you know, a financial expert and economist, right? So I'm glad to have him on today to pretty much talk about everything that he's doing. And I'm going to talk about his book and his latest writing that he just did as well that I saw. So, Mr. Lars Krojier, welcome back to the Investor Show.
Thanks for having me.
Oh, awesome. So now we're in some very troubling times. I know you're out there in the UK. I'm here in Denver, Colorado, as you can see in my beautiful background there. So I'm here in Denver, Colorado, and I wanted to get your idea. Well, first of all, you know, tell everybody a little bit about yourself, because I'm pretty sure I missed some stuff.
Well, I'm Danish. I lived in the US for 10 years. I went to undergrad and graduate school there. But I've lived in London the last 20 plus years. I had a hedge fund here for a number of years, and I still sit on the board of a number of funds, both here in the UK, but also abroad, including the US. So I'm still very much involved with the industry. I saw you had one book up. I've written a couple of books about finance over the last several years. So I guess I'm involved in that, I say peripherally as well. Then I guess I'm a private investor, and I've also been involved with a charity in the last 4 or 5 years here in the UK.
Okay. All right. So you guys and girls heard it from him live. So we're in some very troubling times right now. And in your latest book, this is one that, you know, that I read a while ago. In your latest book, you and you were talking about in your latest writing as well, in these troubling times that we're having right now, and you spoke about how to invest and have a sleepless night. Can you explain to the people out there, what do you mean by how can you invest and have a sleepless night when we're in turmoils like we are in right now?
Without a sleepless night.
Without a sleepless night.
Look, I think let me start by the premise of a lot of the work I've done, which is, the very first thing you got to ask yourself is, who are you? Who are you as an investor? There's in a wide range of shows and advisors and the press in general, there's this incredible rush to somehow outperform the market, somehow beat the market, pick the right stock, pick the right time to buy stocks, pick gold, pick Bitcoin, what have you. Where I start is really with the premise that, let's just talk about stock markets. We can talk about other asset classes too. I start with the premise that it's actually unbelievably hard to outperform the stock markets. It's unbelievably difficult, particularly considering the costs and expenses you incur as a private investor, to consistently over time do better than the wider stock market or the wider financial markets. But it's not only that. So what I mean by that, by the way, that means if you take the S&P 500 as an example, I'm saying you can't pick better than that index. And we can talk about how that's constructed. You can't pick better than that index any one stock, or even deselect any one of the 500 stocks. And just jumping to the conclusion, you are far, far better off, assuming that your risk tolerance is such that it makes sense, you're far, far better off investing in the broadest, cheapest equity index than you get your hands on. So not only are you statistically, but also in every way, really, highly, highly unlikely to be able to outperform the markets, but also you are highly unlikely to pick the, call it 1 to 2 out of 10 active asset managers that will outperform that index over a 10-year period. And as a result, if your response is such that you should invest in equities, and again, we're just talking equities here, you should buy the broadest, cheapest equity index you can get your hands on. And that is, in fact, the global equity index tracker. And there are a number of providers that provide those. Vanguard is one. There's an MSCI tracker. And that's, I think, the premise of a lot of my work. So I'm not debating whether markets can be beaten. I don't think you have to make that kind of a statement. I'm saying, can you, as an investor, outperform the markets? And if you can come to the conclusion that you cannot, it's my view that your financial life will be far better as a result. So this is actually completely aside to all the stuff that's going on in the world around us right now, which I'm happy to have perspectives on. But I think it's very, very, if you take nothing away from this podcast, then remember that. And at least do yourself the favor of questioning whether you can beat the markets, and you'll likely come with the conclusion that you cannot.
Okay. So guys and girls, that kind of sum up what Mr. Lars Krojier is saying. You could correct me if I'm wrong on this, but you're essentially saying that, hey, to all the new investors out there, to the people that are right now that are saying, hey, look, we're seeing this downturn in the economy. The coronavirus is going crazy. The bull market is out. I want to pick stocks. I see Google is on sale. Microsoft is on, all these companies that are down. And you are saying that, hey, by you picking stocks 9 times out of 10 in the next 10 years, you are not going to be able to beat the index in most cases.
Well, that's not quite what I said. I said, statistically speaking, let's divide it into 2. One is you yourself picking stocks on some online platform. So you go and you check out the news and research the companies, and you pick, what do you say, Google and Apple and what have you. That's one way to go about it. The second is that you pay someone, Fidelity or something like that, to pick the stocks for you. And they will invariably have very snazzy looking ads and things saying they've beaten the market over the last 5, 10 years, what have you. And we can talk about why they have those ads. But so take those 2. The first case is very, very unlikely. If you could do that, good luck to you. Let me know how you do it and go get rich. But that's statistically highly unlikely. The second case is that the active fund managers, because keep in mind, they also, on top of what they charge you, they have their own fees and expenses. They, call it 15, 20% of the cases over a decade, actually outperform the same index that you can buy from Vanguard for 0.1% a year or less. And unless you can pick that, call it 1.5 out of 10 active managers ahead of time, then you shouldn't try. And what are the chances that you can do that? They all look shiny and fresh. And by the way, the ones that have done well in the past, that's no indicator that they're going to do well in the future. So don't be fooled by that.
Got it. So you're essentially, okay, so you're pretty much telling the new investor, the person that's coming in right now that wants to invest for the future, the audience here, a lot of people are 20, 30 years old, and they're looking for opportunities to be able to invest, right? They're looking at, I want to take advantage of this bear market. And you're essentially saying, hey, if you feel like you have an edge over the market, then go get rich, right? But you're saying the likelihood of you going out there, starting an ETrade account or whatnot, and just picking some stocks that you think are doing well, you're going to come out better just buying the index.
Look, I'm not saying don't invest. That's a very important message here. I'm saying absolutely invest. Absolutely invest. But how should you invest? And the reason you should invest is because you hope to gain attractive returns from in the future. Like, let's discuss what's happening in the world right now. But historically, equity markets have gone up, call it 4 or 5% above inflation. vastly superior to virtually any other asset class.
Mm-hmm.
And just, what does that mean in practical terms? That means that that your money, if you had $100 on average over, if markets do in the future like they have in the past, which they almost certainly won't, then that $100 would become $200 in about 15 years, and without you doing anything. Now that's much better than having sit in a bank account where you might even get negative interest these days, and the money would be eroded by inflation. So absolutely you should invest. Now, how much should you invest in equities? Well, that kind of depends on who you are and your personal circumstances. Now, clearly what's happened with this horrible virus is not only the markets have declined dramatically, and individual stocks even more so, but also the risk of the market has gone up a lot. Now, I don't know if your listeners are familiar, but there's something called the VIX index, which essentially is there's a market for the future risk of the market. I know that sounds like double talk, but just accept that for a second, that there's a traded market for how risky essentially the world, but the stock markets are going to be in the future. And before this crash, those volatility indices were at or near the lowest they had ever been. So essentially, the world was saying that the future is not risky. Now, in a world that's not risky, don't expect to be paid a lot. Now, after this virus happened, the implied risk of the market has gone up four or five times. I don't even know, but something that order of magnitude, which is essentially the market saying, look, the future is really, really risky, right? So are you bottom picking? Well, maybe, I don't know, but people that invested 10% higher than now probably also thought that. Right? So all I'm saying is it's really, really risky. Now, commensurate with that, is it reasonable to expect a higher return? Well, yeah, absolutely, right? Historically, risk and return have gone hand in hand. And so it's not unreasonable that you're taking more risk so you get higher returns. But just be sure that you can afford to take that risk, right? So perhaps a terrible example, but let's say you need open heart surgery next year and it costs $100 and you have $105. Well, don't put that $105 in the equity markets. Right? Put it under your pillow or in government bonds or somewhere where it won't erode, possibly, almost certainly won't erode in value. But if you have a longer time horizon and you can afford to lose money, at least in the near term, then yeah, absolutely you should invest.
Okay. Now, it's two things you just spoke about for people out there. Understanding, he's saying that, hey, look, go ahead.
No, I was just going to say about the virus. The virus is an interesting. I mean, it's a horrible thing, but it's also an interesting thing in the sense that this is a global crisis. Right? It's everywhere. In fact, I was just on the phone with my sister who lives in New York, and it's interesting how it's the financial crisis was different because countries were geared differently. This thing, we're all having to do similar things eventually to protect our old and protect our societies. So for the first time, I think a global diversification is not as powerful as it has been in the past. So the reason you diversify is, you can buy equities in Australia and Japan and the US, and if you buy a global index tracker, that's essentially what you're doing. Now, the diversifying benefits is that, of course, if you're American, well, you shouldn't actually necessarily invest as much in America because you're already plenty exposed to the American economy through your house, through your job, through your other investments. So you should diversify away from that. And that's a powerful message that a lot of people don't heed as much as they should. But what's interesting about this crisis is it is really a global epidemic. And it actually points to that the world has gotten more interconnected over the last several decades. Right?
Now, on the other side that you spoke about in your book, you say, hey, get you a global broad index. And when he's talking about a global, we here in America, we look at the global index as the SPY, the S&P 500. But when he's speaking about global, he's talking about
sports, you claim to be world champions, even if it's only American teams playing. It's almost like no one consults now.
America is arrogant that way. America is arrogant that way, though, Lars. You know that.
And you should know you represent about 4% of the global population, right?
So, and that's why I wanted to bring you on to get that outside perspective for people to say that, hey, there's other economies out there outside of just America and the S&P 500.
Absolutely. But keep in mind, like if you look at most people, so I don't know much about your viewers, but most people have tremendous exposure to their local economies, right? Through their job, through their education, through their house. Even if you lose your job, your next job is likely to be local to your partner's job, maybe your inheritance. If you look at all your assets, almost look at it holistically, they're all very tied to your local economy, and by extension, your national economy. And so the one thing you can do is when you're buying your equities, you can put some of that elsewhere. Right? There was actually much more prevalent in the last financial crisis where you had pockets of complete disparity between how the various housing markets did. So there were people particularly Florida and Las Vegas, that went horribly bust. And around the same time, in 2 years, people in London did phenomenally well. Right? So those people in those local economies, if they had diversified away from the local economy with at least their public equity investments, they would have fared better. They wouldn't have all their eggs in one basket. So when you say the S&P 500, of course, it's a very, very broadly and popular index, but why not go broader than that? Do you really have any reason to think that the US markets will fare better or worse than the global markets over the next 10 years? If you do, you're a genius. You're smarter than Warren Buffett. And if you don't, at least accept the diversifying benefits.
Okay. So for the people out there that are listening that can say, the people that can
add to one thing.
Okay.
The S&P 500 is a unique index because it includes very, very large global companies. Right? So if you look at Facebook and Google and Apple, I think more than half their business is outside the US, despite them being US businesses. So you indirectly get diversifying benefits. These are not local real estate businesses. These are large global companies. But it is true you're getting less diversification than you otherwise would. You're also getting diversification from foreign exchange exposure. So, but that's another point for another time. Okay.
Now, so people are saying, okay, so he's speaking about the total broad index. So people are saying S&P 500, NASDAQ, S&P 500, NASDAQ, and the Dow Jones. He's speaking that, hey, go outside of your local economy, which is in the United States, and go get a total broad market index, something like Victor Tango, which is Vanguard's version of the total market index, right? Now, another thing you spoke about was you're saying that, hey, when you're doing your equities, just get your total broad index, boom. And you spoke about another side was the bond side of the house. Why add in bonds, and what type of bonds you want to add to a portfolio?
So that gets slightly more complex, but I think what I'm trying to do is to say that you can, by the way, if we can just go back to the diversification just a tiny bit. When I'm on these media programs in my native Denmark, this is a more important point, right? Because the US portion of the global stock markets is pretty high. So if you fail to diversify beyond the US, it's not that big a deal. You'd be better off for diversifying. Man, you're from Denmark, and the Danish stock market, which is actually done far better than the US one, but it's 1% of the global stock market, right? So if you only have that, you're really tied to the Danish economy, and you really should diversify beyond it. You see what I mean? So it does depend a little bit on which market you're in. But the larger point on bonds, well, so we earlier talked about how equity markets are very risky, and that may not suit your personal risk profile. Now, your risk profile depends on a number of things that's dependent on you. How old are you? What's your job situation? How wealthy are you? What's your future wealth look like? Et cetera, et cetera, et cetera. Even down to, what's your risk tolerance? How do you feel about the prospect of losing money? So let's say that for whatever reason, the heart surgery example before, where you needed $100 in a year and you had $105 now. Well, don't put it in equities, right? You say put it in the bank. Well, banks go bust too, and also they don't give you a lot of interest. So for a U.S. person, government bonds are one of the least risky securities that you can get your hands on anywhere in the world, because you're not taking foreign exchange risk, and you have the credit of the U.S. government behind you. And so that's what I'm saying, man. You can just buy two things in the world. One is this global diversified equity tracker, and the second is U.S. government bonds. And by the way, buy them of a maturity that roughly matches your time horizon. So if your time horizon is 2 years, buy 2 years. If it's 5 years, buy 5-year government bonds. So what are you doing there is you have now two assets. And one's very risky, named global equities, and the other is the closest you can come to a riskless asset, named U.S. government bonds. And you can combine those two according to the risk profile that you want. And then you have created a very robust portfolio with just two securities. So that's pretty simple, right? So if you're very risk averse, maybe you have $90 out of 100 in the government bonds and $10 in equities. And if you're younger and more risk loving, maybe you have the opposite. I don't know. Depends on who you are. And maybe go online, find some of the risk calculators. But the beauty of this portfolio is you haven't paid anyone to be clever for you. There's no one in a suit making a lot of money here. You're just going to Vanguard and buying both of them wherever you think you can get it cheaply, and you just let it sit there. And then you add to it when you can, and maybe you shift it around if your risk profile changes. But that's all you have to do. So when I say you can sort of invest without sleepless nights, well, it's not that you're not going to lose money if markets go down. You're definitely going to lose money because you own the market. But you really can't do a lot about it. And because of that, you can rest assured you're doing the right thing.
Okay. So you're pretty much making it simple, because I've seen a lot of people come in and they have a watch list of 20 stocks or 30 stocks of what they want to buy, take advantage of in a down economy. And you come in and just say, hey, look, if you got a total market index and you got bonds, if you match those to your risk levels, you can invest and get rid of speculation and have a sleepless night.
Well, I mean, put it another way, if I knew 20 stocks that was going to outperform the market, I'm not sure I'd go on your show and tell the world about it. I mean, I'd probably charge someone a lot of money to say that. And I did used to run a hedge fund, so I guess that's what I used to do. But trust me, it's not easy. It's not easy to outperform the market. And there's also a huge selection bias. The only people that go on your show are the people that have done it in the past. So you don't invite people to the show that haven't done it in the past. So that's perhaps half the people. So, and then I add to that the people have a way of saying they have been. Add to that we're inclined to believe we have been more successful in the past than we have been. So I'm just saying, can you individually believe the guy that goes on the show, one guy versus another guy, one guy you go on any of the many, many TV channels and they all say something different, sometimes opposing views. You read the newspaper, they say a third thing, other radio shows a fourth thing, your advisor a fifth thing. Are you really equipped to make those calls? Who's right, who's wrong? And if you are, well, good luck to you, but chances are statistically you're not. So what is it that you know that the rest of the world doesn't? The global equity markets is what, 70, 80 trillion dollars of really highly paid people spending a lot of money with access to the best information, best resources, best company, best technology, best everything. And you're saying you know better than all of them. It's actually staggering arrogance.
Yeah, I do remember you said that about, can you kind of give people a glimpse into some of the access that hedge funds have resources to? When you spoke about, you get to go to these meetings and you get to meet with all the top executives, stuff like that, because a lot of us haven't been even exposed to that to even know that exists. Can you kind of tell the audience a little bit about what they are up against when they're going up against big hedge funds?
Well, it's not just big hedge funds. It's anyone with a lot of money, right? You see management, you see companies, you get the tours, you get all the best researchers in the world working for you. You get all the best technology to look at stock price movements, liquidity. You get the first phone calls about information. You get all the industry analysis. mean, you have, chances are you know some of them privately because you went to school with them or you study with them or you build technology with them. And what's the real chance that someone sitting in boxer shorts in front of their computers is going to beat that? It's pretty slim. It's possible, but it's pretty slim. And if it is done, just make sure it wasn't luck, right?
Okay. So
I don't have the virus, by the way.
You know how to? You sure you got the coronavirus?
I know a couple of people that have had it. It's kind of interesting.
Oh wow. So if you got questions for Mr. Lars Krojier here live while he's on live, you can bring up your questions and I'll bring them up live. I know Adam here says, welcome, sir, from Houston. And the whole idea that you spoke about, he just said, hey, with a hedge fund and they get to, well, anybody with a large sum of money, they get to pay for the top advice, the top research, the top everything. And he's saying, what's the likelihood of someone sitting in front of their computer screen and boxer shorts that it can beat that? And even with all that information, all that insider information, you still say it's tough to outperform the market.
Not illegal information, but well,
hopefully.
When you say inside information, the suggestion that
legal info. So even with all that information, with the Bloomberg terminals, all that stuff like that, you still say it's hard to outperform the market.
Yes.
Wow. And
otherwise they'd all be doing it, right?
Yeah, that's true.
So think of all these active managers. By the way, when you say active managers, what you mean by that term is someone who's actively selecting and deselecting securities. So someone who buys Facebook but not Google, or vice versa. And what I'm saying is, after fees and expenses, that group, only about 1 to 1.5 out of 10 of them outperform the market over a 10-year period. Right? So, I mean, those are the best informed, best educated, best access to everything investors you're going to find. And because of all the fees and expenses and the compounding of all that, they tend to not outperform.
Wow. Do you think it's maybe the fee structure needs to change? Maybe lower fees? Like we live in a low fee to almost no fee society now. ETrade is free and TD Ameritrade is free.
By the way, be aware of free, right? It's not free. They find a way to charge you.
Oh yeah, I would say change it around because they got to be in business some type of way. How they, I would say, changes in the fee structure, right?
Yeah. Hopefully,
So do you say there need to be a change in the fee structure?
It's come down a lot. I mean, people used to pay a lot for essentially index type exposure. That's changed. So that's gotten better. And I mean, there's room for it to get better still, but yeah.
So even in the hedge fund business, is that even a business to even go to or whatnot? Or what do you say about the future?
It's a fascinating business. Absolutely. If you can do it and do it well, first of all, you make you very, very wealthy, but perhaps more interestingly, it's like, I mean, what I always liked about it was you have an ability in the hedge funds to create the exact kind of exposure you want to create. Take luck out of the equation. I always thought that if you make an investment in a stock, just any old stock, so big a part of your returns is going to be dependent on the future of the economy and the markets in general, which you don't necessarily know. But if you buy one stock at the same time, sell another stock, you're creating a different kind of exposure. And you can get quite nuanced about that and create an exposure that you think reflects exactly some sort of an insight that you have. And that may not be market correlated. It sometimes is. But that's interesting. It's interesting work. And if you can do it well, it's absolutely fascinating. You get to work with really, really interesting and smart people. They're not all these Ferrari driving, cigar smoking morons that you see in the movies. A lot of them are really, really fascinating and people that are deeply interested in the world around them.
Okay. So we have one question here. Max B says that do you think bonds are still good even with the low yields?
It's a tough question. I mean, I don't really have a strong view. It sounds absurd given my background, but I don't really have a strong view on a lot of these asset classes. I think what you should start with is say, obviously it kind of sucks to not get a lot of interest from owning bonds, but that's the world we live in. And can they go, at some point bond yields can't go a lot lower because people will start hoarding cash, right? But at the same time, I think you should almost think of it more in the context of your overall portfolio. What does a bond exposure do to your risk, your overall risk? And accept that if you want something very, very low risk, you're not going to get paid a lot for it. You're actually getting paid a historically very low amount for it, but that's the world we live in. Think of it as more like the risk calibrated. And here I'm talking these U.S. government bonds. Of course, you can get any risk profile you want in the corporate bond market, including some very high risk ones. But if we're just talking about these government bond risk, well, if you want a lot of return, you're going to have to accept some risk for that, and you should think about how that fits into your life rather than sort of speculating on the movement in bond prices.
Okay.
Well, typically in these kind of crises, it's an escape asset, right? It's where people put money they don't want to lose.
I had a question for you. Could you tell the audience out there, your hedge fund days, how large did you grow your hedge fund as far as assets under management?
We had about $1 billion.
How much?
$1 billion.
$1 billion. Lars, could I borrow $5? So now, with that being said, with that large amount of money, right, and all across the different asset classes,
this is a long time ago, right?
Yeah, 2008 when you kind of, I know you were.
I was very, very lucky. I stopped right before the crash.
So you started right before the crash, and you got out right before the 2008 crash. I mean, you got out right before the 2008 crash, correct?
Yeah. Well, I'm still involved in these investing in funds and sit on their boards, which is I really enjoy. And some of them have done far better than me, so that's good for them.
Wow. Okay. We got another question here that says, hello, do you expect small cap companies to outperform large cap companies in general as the U.S. markets come out of the correction territory?
If the market does well, then I would expect that to be true. Traditionally, smaller cap companies have a higher gearing to general good performance than large cap companies. It's not always true, but traditionally, I think it used to be called the small cap bias. So essentially, think of it this way: that if the S&P 500 goes up 10%, small caps tend to go up, call it 15%. But this has historically been the case. Now, of course, the adverse is also true, right? That if the big companies go down a lot, the small caps go down a lot more. Okay. But again, be careful about these rules of thumb because every time it's different. Right?
Okay. All right. So you're pretty much saying that, hey, when the rule of thumb is
anything, I guess, which is not very helpful.
He's like, he'll say something. He's like, well, you got to be careful with that because that could change. But
yeah, so it's also true, right? It's if it was always that predictable, the market would price it in. But I do think there is some truth. It's a bit like emerging markets has historically done better in good markets and worse in bad markets. But actually, the last 5 years has been an exception to that rule. But that's sort of a rule of thumb generally. Okay. But again, with caveats. Right?
Now the question is, how do hedge funds grow to become that big? Like, these $1 billion of assets, and how do they grow to become that big?
They take investors. Some of the big funds are $50 billion hedge funds. And basically, it's that simple, right? You get institutional investors that invest hundreds of $1 million at a time, and you get enough of those, and very, very quickly you're running a lot of money. And you do it for years and years, and you perform really well for them, and you can get staggering amounts of assets through the door.
Wow. But what are these people at? I don't ever see these institutional.
Huh?
Because I see it happen all the time. You know, I know.
And those are right in those buildings behind you.
They're right in the buildings behind me.
Right, absolutely.
Just gotta go talk to them. All right, but
find the right floor in that landscape behind you, and you will. No, absolutely. You're kidding me. I mean, the big endowments, the insurance companies, the pension funds, the ultra high net worth individuals. And that's just now we're just talking the U.S. Then go abroad. It's staggering wealth.
Wow. Okay. So, do you ever see yourself coming back to the hedge fund business, or are you just done with it completely?
I think I'm done. I enjoy being on these boards. I enjoy that actually. It's nice.
Okay.
It's a nice way to stay involved, but I haven't had a day yet where I'm sort of dying to go analyze a bunch of stocks or something like that. No, but some people love it. I think it's one of my mistakes, frankly. There are people that love it more than I do. There are people, when it's Saturday, they wish it was Monday so they could go analyze stocks. Right? No,
wow.
Do them.
Now, to a new person, right? Well, even back in your day, last decade, do you want to give any tips on how do you analyze stocks?
Oh, I think that's a longer conversation. I would certainly say anyone that think they can teach it to you in a short amount of time is full of shit. So study hard, study long, learn from really good people, and don't ever think it's easy. And I know that's not saying a lot, but these like learn to pick stocks in 15 minutes or buy a book and I'll teach you how to beat the market. No, don't do it. And certainly don't give money to anyone like that. Right? Because that's, yeah. I mean, I tell you, there's a friend's tennis coach approached me recently. I was offered some amazing opportunity to, 20% return every, I think it was yearly, and asked me if he should do it. And I was sort of like, what do you think of the chances that they need your money if they have something that can provide that outstanding returns? That they need to go find a tennis coach who can give them maybe $500 or $1,000. It's staggering unlikely to be the case, but I don't know the first thing about it. It just seemed too good to be true, and it probably was. I don't know. So just be aware of those things. It's very rare that I think you have. I mean, even for me, and keep in mind, I'm like I'm an actual like angel investor and stuff. The first question is like, why do they need my money? You're so bloody good. In your own industry, why don't you have your people falling all over you? So just don't do that. And that's another thing about all this, like investing in a broad symbol market exposure is you're probably not going to get ripped off. And that alone is worth a fair bit.
Okay. Well, Al comments, he said, I love this guy's honesty.
Well, thank you. That's very kind. Appreciate that. But look, it's one of the problems, to be honest, is I don't make any money from saying this. I mean, my books sell some, but I give that to charity, and it's not a lot anyhow. So that's one of the problems, that all these people that put up the ads or send stuff in the Post or whatever they all do these days, they all got to get paid. Even the financial news programs, they all got to get paid. And they get paid by the advertisers. And the advertisers are trying to sell you shit, right? So there's very few people with a vested, even you, mate. The reason you couldn't have me on every week, because I'd say the same thing. You'd soon run out of viewers. And so the problem with it is you have tremendous vested interest in having people do something super active and expensive. Very few people are interested in telling people to do something pretty boring that doesn't pay a lot of fees. And you certainly don't get invited to the football, right? So, and that's sort of what I'm saying. And I don't know. I mean, it's a pretty unrewarding thing to say. I'll assure you that.
Okay. Now, Max B has a question from Louisiana. He said, how could you become a hedge fund manager?
Well, essentially, so I'll give an annoying answer to that. I do actually have to run in a minute, but what is a hedge fund manager really, right? It's just someone who's managing a pool of capital. Okay, you have to be approved by the relevant authorities, and there's a problem. I think in the US it's the SEC, and there's a process.
Mm-hmm.
And then essentially all a hedge fund is a pool of capital that you put in a fund. Think of it that there's a legal minimum of money that you can take, and there's some specific regulations around hedge funds. So in other words, you can't just approach people on the street. They have to be, I think the term is sophisticated investors or high net worth individuals. But assuming you know enough of them and you can convince them to invest with it, anyone can create a hedge fund. You need to be regulated and you need to pass the rest of the relevant exams. And then you need to do well for a while. And once you do well for a while, more people will give you money. Right? The concept is pretty simple, right? That you manage people's money, you do well with it, and you do well for a while, and more people will give you money. What's hard is to actually perform well. That's the magic, right? I mean, if you are the next Warren Buffett, people will probably eventually find you.
Mm. Okay. Well, Lars, I know you got to get running. I want to say thanks for coming by. Thanks for being my mentor out there in the UK. And one of these days, I want to make it out there.
Good luck, and good luck with this virus. I'll tell you, we all hear about you guys are not taking it seriously now, so you got to take it pretty serious. It's a big deal.
It's the first time America has seen something like this. That's why.
I think the world has seen something like this, but the thing people don't get in this is the power of exponential curves. Right? They go incredibly quickly, and if you see the number of deaths rise at this exponential curve, it's going to be horrifying. And the US is still so early days in this that it's still not enough deaths to have the US take it seriously enough. And also there's been very, very few tests done in the US relative to the rest of the world. And it's if you really, really, and once you see these deaths rack up a lot, that you take it really serious, you're about 14 days too late.
Wow.
Anyhow, so I will say that, but it's not part of this conversation. I don't have any special insight into that. So
okay, just want to let you know. Some Al said earlier today he brought the Schwab Total Market Index Fund. He will be doing more research so he can invest into the global index. He says thank you for all the information. Marley says thank you greatly, and we have another one says thank you, Prince and Lars. All right, Lars, is there anything that you want to leave the live audience and the people that catch the playback? How can they follow you? How can they grab your books? I know he wrote a book called what it was, the Truths of a Hedge Fund Manager, or the Untold Truth, something like that.
Oh, yeah.
Confessions of a Hedge Fund
I have videos up on YouTube if you're interested. They're pretty well viewed, and just trying to keep this sort of message simple and keep it out there. There's also some stuff on how to build financial spreadsheets and stuff. So, and of course, you can buy my books. If you can spell my surname, you can find my books. That's normally the challenge. But thanks very much for having me on, mate. I appreciate it.
All right. Thank you, Lars. Once again, ladies and gentlemen, boys and girls and children of all ages, this is the Investor Show. Until the next video, podcast, cartoon, or whatever else you see me do crazy around the globe. Peace, be safe. I'm out, and thank you.